Today's cardinal lesson, we're going to talk about the why and the how of long-term care insurance planning. Or another way to put that, we're going to be talking about the emotional, or the left side of the brain, and the logical, or the right side of the brain. I hope I have those straight. Maybe I don't. Maybe I have them mixed up. But you get the point. So we spend too much time as planners, financial planners, when we're doing plans for people, talking about the logical side and the money and the cost and the premium and the benefits and the maximum of the policy and all that kind of stuff. And the whole time people are listening to us or we're having a dialogue, they're thinking, I ain't going for this. I don't want any part of this discussion. And so we're going to start over here today and we're going to talk about the why. I mean, why are you even watching this video? Are you open to whether you need long-term care insurance or not, whether you're going to buy it or not, and whether it's going to solve a problem that you've accepted and want to do something about? So the first point under the why is, if you need care later in your life and you need it for a significant period of time, sure, you're going to have your burden of the fact that you're having to be cared for, you're not well, people are having to do things for you that you're not used to, possibly having to pay for it or some of it. And so you've got your burdens, but who bears the real burden of this are your adult children and your spouse. Those are the caregivers, and whether you have insurance or not doesn't really relieve them of much. This is more their problem than it is your problem, because you're in your 80s or 90s, maybe your 70s, and you're needing care, and you're really focused on your just day-to-day and well-being and trying to enjoy yourself, trying to eat your meals, get your exercise, take your medicines, do some reading, whatever it is. You're just focused on getting what's left out of life. And they are the ones that are thinking about, how are we going to pay for this? Who's going to care for dad or mom? Who's going to take care of them this weekend? And who's going to take care of them during the week? And who's going to relieve mom? And what if mom gets sick and then we got mom and dad sick, or vice versa? I mean, it's your family that really bears the burden of this. And I know this from personal experience. And I've written about that quite extensively in my book. So you understand that planning for this problem and getting a plan together of, like, what are we going to do if this happens to us, is really a very loving thing to do while you're in your 60s. And we talk to just about everybody that walks through our door or comes across our Zoom screen about this subject. So next point is, where are you going to receive this care if you need it? And, there's really two choices. I mean, there's a whole variety of choices, but you can put both of them into one of two categories. You're either getting care at home, you're staying right where you are, and people are coming in, professionals are coming in to take care of you and do things for you, or you're going to an assisted living. And that's hopefully by choice. And that, an assisted living is a nice modern name for what used to be called a nursing home. But an assisted living is a place where you live. It can be an apartment. It can be a room, like a little more like a hotel room, or it can be a small one-bedroom apartment. But regardless, there's care that's part of your rent, and they're going to come in and do things in the assisted living for you, just like you were having done at home. And most people, and I know my preference, I want to stay home as long as I possibly can if I get in this situation, which puts a lot of burden on my wife. And that's why I have long-term care insurance and significant long-term care insurance, so that she's still going to bear a big burden if I was to have a stroke or something, and then she's caring for me. whether we have this insurance and we're bringing people in or not, she's going to bear a big burden. And so are my two sons, and their wives are going to be part of all of that. So this doesn't relieve the whole burden, but it certainly helps. So where are you going to receive your care? My preference is going to be at home. And if you just look at trends, especially through the pandemic, home is really where more and more people are getting their care for longer and longer and longer. Now, the next thing to really think about is that what do you get out of this? Well, you maintain your independence because you're staying home and you're actually paying the people that are coming in and doing the heavy lifting anyhow through the home health care agency. And you're doing that with your money or the insurance company's money, which is really your money because you've paid premiums for this. And it's maintaining your dignity. So you're not having to become indebted to people, I guess, or as you're getting this care. I mean, your kids and your spouse are going to take care of you because they love you. But if others are having to do this, or you're getting on government benefits or that kind of thing, this is a way that you can maintain your dignity and your independence. And I guess the final point on the emotional side here over the why is it just makes sense to protect your money. I mean, you have insurance right now. If you have your home insured in case there's a fire or in case there's a break-in or a flood or something. If something to this valuable asset happens and you have a big expense, it's going to be covered by the insurance company, or a big part of it is. If you have an expensive car or a vacation home, you have health insurance so that if you have a big hospital bill, and this is a matter of as you age, if you need care, the cost of the care is expensive, and it makes sense to insure that. Now I want to shift from the why to the how. And so what we've done today is we've shown you two possible solutions, but we've demonstrated an unlimited policy. Because I was reading, and Tom's going to take you to some statistics that show that there's a greater number of people spending longer and longer and longer needing care and paying for care. And so to have insurance that doesn't have a limit on it is very attractive. And we have a lot of people buying these unlimited policies. And we really only have two companies that offer that. And under each of the two types of care, types of insurance, the hybrid and the long-term care, we're going to show you an example. And these are the only game in town when it comes to just not having an overall maximum on your policy. So, and what we've shown you is $9,000 a month. That's the same on both of these. So $300 a day, $9,000 a month, $118,000 of benefits a year, and then with an unlimited time frame. So I've just demonstrated, if we wanted to put a number on it, over $1 million is what this thing's going to pay out if you needed care over a period of 10 years. So, and if there's two of you that needed it, this one over 1 million is each. And if you're still kicking and needing care after 10 years, this thing is unlimited. It just keeps on paying. But I'm trying to quantify the types of money that this policy can kick out to you in the future. And so, and then what we've demonstrated here, and by the way, this is for two people who are 64 and 64, which typifies people coming into us. When people are joining Medicare, they're coming to it for the first time. We have a lot of people coming into our services and engaging us for services about Medicare at 65. And so this is the age. So I'm showing you a couple, and we're going to cut to Tom here in a sec, but these are two people, 64. And if you really want to know, well, what about one person? What if I wasn't buying this as a couple? You can take about 60 to 65% of this, any of these numbers, either choice, for a female and about half for a male. So ladies have to pay more for this type of insurance, long-term care insurance now, because they have a greater likelihood of using it. So, with that, I want to cut to Tom, and I want him to give you the specifics and compare these two options.
Yeah, and so what we've been doing on our recent videos is having these show notes to go along with the video. You can find those in the link below on the video. We also have a spot on our website where if you want to go back and find past ones, we have them there. But I'm going to jump to a page here that's in this study that's part of these show notes that is really talking about these statistics that John was just mentioning. And so, it goes through and looks at the duration of care needed. And they go and look at real data of actual claims. But we just want to draw our attention to that 10% of the people who need long-term care are needing it 8 years or more. And so there are a lot of people that need it for shorter periods of time, but this 10% is growing. And so really the point of these policies that we're showing today is showing for those people who are worried about that real extended period of care, what does that kind of look like to cover here? And so I'm going to scroll back up and we're going to go look at the specifics on these policies. And so like Hans was saying, there's two policies. One of them we've shown two different ways to pay for it. But this first policy is that hybrid long-term care policy. And if you haven't watched our previous videos, this is a policy that has a death benefit if neither one of you, because this covers both people, if neither one of you needs any care, there's a death benefit going to the beneficiaries, which are often their kids. And so this is showing it, paying it with just a single premium, a one-time transfer, and then you're done. And to get lifetime benefits, it costs $272,793 of premium here. And what you get for that is a monthly benefit of $9,000 per person. So if both of you need it at the same time, it will pay a total of $18,000 a month. And if that will last for as long as either one of you need care. And if neither one of you need care, again, it has that death benefit of $300,000, which is a little bit more than you paid into it. The death benefit really isn't the reason we're purchasing this policy. We're purchasing this policy for the long-term care benefits, but the death benefit is a nice feature where at least someone's going to get a benefit out of this policy. You don't feel like you've just spent your money and it didn't go anywhere. And so this is the one way to pay for it. The second page here is the same policy, same benefits, same $300,000, $9,000 a month of long-term care benefits, except we're paying for it over 10 years as opposed to a single premium. So they let you, there's a way to pay for it where some people don't want to come up with that amount of money right up front, which is understandable. And so they want to pay for it over a 10-year period. The nice thing about paying for it that way is there is at least an end to those payments. It's not this cost, it's ongoing forever. And so to do that, it does take a little bit more total money, but it's $34,383 a year for 10 years, which results in about $340,000 of total premium. But again, it's spread out. You have the same death benefit of the $300,000, the same monthly benefit of $9,000 a month. And again, that lasts for as long as either one of you needs care. The second policy really is a traditional long-term care policy. This is not one that has a death benefit at all. You really are truly just paying for the care. It's kind of like home insurance or your car insurance. If nothing happens, there's no benefit, but it's a way to cover the risk. This is a little less expensive. It's $32,307 over a 10-year period. And so you don't have that same $300,000 life insurance, but it does have the same $9,000 a month of long-term care benefits. It has the same lifetime benefits. It covers a husband and wife, two people. And so it's the same long-term care benefits, just without the death benefit. I will say this one is harder to qualify for from an underwriting standpoint than the hybrid policies. These can be very restrictive in who they take, but it's still a way to do this. And some people just don't care about the life insurance. They want to save a little bit of money. If I'm comparing this to the other one, I prefer the other one because I think the price isn't that much more to get that that death benefit feature, but some people really like this. And so this is another way to cover that lifetime risk. And like Hans was saying, these are really the only two companies we have that offer lifetime benefits. It used to be that more offered them, and a lot of the companies have stopped doing it because it's a big risk for them. They're seeing the trend. And so these companies have stayed in it, and it's a great benefit for our clients.
Now, what I want to add is this is after-tax money that you're putting in here. So if you put in the $272,000 and pay it in a lump, you're doing it with money that you've already paid taxes on. There is an option to use IRA money to buy this policy. And that's frankly what most people end up doing, because those are the accounts that people have this and more amounts of money, and they want to look for a purpose of that. And all they simply do is they set up over here to the side a lump of money that is coming from an IRA. So you don't have to pay taxes on it all at once. You just move it from where it is into this separate policy over here. And then out of that policy for 10 years, they just take this amount of money and move it from the IRA into the hybrid life long-term care policy. And then over 10 years, then the IRA portion of this is just depleted. So it in effect creates the same thing, but you're buying it with IRA money. So if you're interested in that, you need to get in touch with us. I want to also point out is this is a pretty loaded up policy. I mean, it's got the inflation built right into it right from the beginning. So you're just starting at $9,000 a month. And that's what your benefit is going to be. If you're using it in like 20 years, it very well could be not enough. But frankly, to have most of it covered is going to be much better than going with a much smaller benefit and then having the inflation go on through the years. You could, if this is just too much money for you, this is just one example. We can cut the money down by a number of ways. One is we can just sell you half the benefit. You just cut everything in half and you start with a $4,500 a month benefit, which is $54,000 a year. It's still unlimited, but every number on this page would just cut in half, and you would have half the benefits, which would certainly be valuable to you in the absence of needing care. I mean, the absence of having insurance when you're needing the care. So we also can cut the price by putting a limit on there. So we can push this back, and that opens us up to several other companies. So this is just an example where it gave us with very similar benefits. I mean, they're almost exact. They're not exact, but they're close. The 10-pay is. And then we also, if you were interested in the traditional long-term care and paying for it over, a period of time, instead of the 10-pay, you could go with the pay for life option, which is, about $1,200 a month. And you could pay that for two people and you'd have the same coverage. You would be subject to a few things. Number one is they could raise the premium on this. They can't on this or any of this stuff. Once you buy it, they could never have a premium increase, but on this continuous pay option, they could. So I really want you to emphasize is this is not the stuff that gets people to act on this. I mean, it's just all the logic in the world is not going to take you to a good place necessarily. A lot of times it's going to take you to a point, if it's that much money, the heck with it, I'm not going to do it. And I just want you to emphasize and go back to the beginning of the presentation and just think about all what I talked about is you do this for your family, you stay in control of where you receive the care, you stay independent, living at home, paying your own bills, doing that sort of thing. Maybe with your kids helping you a bit, but you have paid help coming in. And you feel good that when you are paying for this care, you're using the insurance company's money. for this instead of your own. It's really hard to talk older people, even if they have lots of money, into spending some of it on themselves and on care. And the whole insurance principle makes that a lot easier. So with that being said, I'm Hans Scheil, and I thank you very much for listening.
Thank you.